Today was one of the most interesting days we've seen in a long time. The S&P 500 itself was down 1.18%, kind of carrying through with a lot of that selling we've seen in the last couple of weeks. However, unlike most other days, we had about half of the stocks in the S&P 500 close in the green today. This was really created through a scenario where the Magnificent Seven has really been tumbling hard here in the last couple of days in particular, and that has caused some disruptions underneath the surface of the market. In tonight's video, I'm going to go through a number of ratio charts that I typically don't go through in my normal routine to show you that we are starting to see some diagonal breakouts in areas that were kind of long since forgotten, and they're kind of starting to come back to life here all of a sudden, especially on a relative basis. In addition to that, of course, we're going to have our trade application example. As most of you know, I enjoy selling puts on stocks on days when the S&P 500 is down more than 1%. Today is no exception. I've got a REIT with a good reputation that's been on hard times here recently, but really broke out in a big way today, and we'll see how that goes for a put selling opportunity. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 26th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. You'll also find which stocks are giving you overbought and oversold cluster signals at the bottom of those emails. I have no doubt we'll have a lot of oversold cluster signals once again in tonight's email. In addition to that, we're heavy users of X, formerly known as Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee, and we really appreciate those of you that click like and repost on this Market Outlook related content. And then last but not least, we do have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here in front of us. It was another ugly day for Wall Street. However, you will notice that it was not one-sided today, the way that you might assume when you hear that the S&P 500 was down 1.18%, which is a substantial sell-off. You can see there's plenty of green on the board. So today felt a little different than traditional sell-offs of this magnitude that we've seen in the past. And of course, the reason behind that is we've seen a lot more underperformance from the Magnificent Seven here more recently. Let's go ahead and review those here now with today's activity. Remember, yesterday, Microsoft was the big star. It was up about 3% on a day when the market struggled. It was the only one of the Magnificent Seven that was up yesterday. Today, none of the Magnificent Seven were up. In fact, Microsoft is down so much today, it fully offset all of the benefit it received after reporting earnings yesterday and is now down on the week. So Microsoft is down 3.75%. Apple did not fare much better. It was down 2.46%. Remember, those are the two largest publicly traded companies on planet Earth. Those are some pretty sizable sell-offs there on this day. We also saw that NVIDIA was down about 3.5%. Alphabet followed up yesterday's stinker with a 2.5% move lower. Remember, they were down, I think, something like 9% yesterday after reporting their earnings. So tacking on an extra 2.5% today, a very ugly week for Alphabet. Meta was down 3.7%. They reported their earnings yesterday after the bell. And initially, the stock popped higher, but as you can see, once we got into the normal session here today, sentiment changed pretty dramatically and ended up being one of the worst performing stocks in the market. And then down below in the discretionary area, Amazon was down 1.5%, Tesla was down 3%. So you can see that the Magnificent Seven were not so magnificent today at all. And Amazon is going to do what it can to try to turn the sentiment for tomorrow's trading. We'll see if it can get it done. We're going to take a look at their trading after hours here in just a little bit because they did report their own earnings announcement here today. So anyway, Magnificent Seven put a lot more pressure on the market today. If anything, most of the tendencies of the market earlier in 2023 was the opposite. where the rest of the market was really struggling, but the Magnificent Seven was bailing the rest of the market out. Today was a reversal day. Today was a day when the Magnificent Seven was doing much, much worse than the typical other stock in the market. Not to say that there weren't other big losers. Speaking of which, let's go through a few more. You can see here that Eli Lilly struggled today. That has been one of the superstar stocks within the healthcare space this year. Of course, the American company behind a weight loss drug, competing directly with Novo Nordisk overseas, it struggled today, down about 3%. Comcast had a strangely down day. This is not a stock that typically moves a whole lot, but today stock definitely got hammered, down about 8.5% after reporting their earnings. We saw some of those semiconductor names affected negatively, including Broadcom and AMD. We also saw that Visa and MasterCard really struggled. And again, those are not typically the types of companies that move with this much aggressive activity, about 5.5% in terms of MasterCard, 2.5% there for Visa. Nike had a tough day, down about 3.4%. You see that Altria really struggled. In fact, at its lows today, Altria had a rare 10% dividend yield. You guys have heard me use the tongue-in-cheek phrase in the past of the 10 and 10 rule. And usually when I'm referencing that rule, it's more of a guideline as opposed to a hard and fast rule. Nonetheless, the idea behind it, if a stock is yielding 10%, stay away from it with a 10-foot pole, because there's usually cockroaches that start emerging from that situation. I do kind of, think of Altria a little differently in that regard, because Altria almost always has a higher yield. Now, granted, 10% is pushing it, but Altria is the type of company that oftentimes has like a 6 or 7% yield. So it's a little different story than a traditionally 2% yielder all of a sudden becoming a 10% yielder. Nonetheless, there are definitely some concerns out there in the marketplace, and we all know that Altria's business of selling Marlboro cigarettes here in the United States is probably seeing declining volumes, and it's just a matter of whether those fewer cigarettes that get sold from here on out can be sold at higher and higher price points. In the past, that's worked out pretty nicely for the company. Moving forward, anybody's guess, but that was a really tough day there for Altria, and now has an ultra high yield, probably, if not the highest in the S&P 500, certainly up there amongst the highest. You saw some of the transports really getting hit today as well. Notice that UPS and FedEx really took it across the chin. UPS down about 6%, FedEx down about 3%. There's a smaller company that you see listed there kind of at the bottom of the screen, CHRW. Some of you saw me tweeting about that one earlier today. That is a dividend aristocrat company that is in kind of the trucking space. It's more of a logistics company, so it's an asset-light business model, but it's the rare aristocrat that rarely has a 3% dividend yield that, with today's sell-off, including, of course, selling off in recent weeks and months, now does have a 3% dividend yield for the first time since March of 2020 when we were going through the coronavirus scare. So transport's been really getting hit here lately, probably a combination of a number of things. Of course, gas prices have been stubbornly high for most of 2023, courtesy of inflation and war in the Middle East. But in addition to that, of course, UPS has been in the news a lot this year for the $170,000 salaries that they're paying their drivers. And that doesn't just come out of the thin air when you're waving a magic wand. That usually cuts into your margins and makes you wonder if it's the shareholders who are going to bear the brunt of the salary increases that were demanded by the unions in that particular case as we move forward. You'll also see here that Edwards Life Sciences really struggled here today. It was down 8%. Align Technologies, which is more of a dental company, was down about 25% today. So that was the worst performing stock in the S&P 500. Second worst performing stock in the S&P 500 was Whirlpool. I don't see where that is in front of me right now, so you'll just have to take my word for it. But Whirlpool was down about 16% here in the trading session today. And one thing that we discussed in class earlier today in my Q&A class, in addition to me mentioning it many times over the last year and a half, is that Whirlpool had stopped raising their dividends well before these dividend stocks fell out of favor. So it was a little bit of a heads up that maybe not all was well within their business if you were willing to read between the lines there a little bit. So Whirlpool really struggled today with their earnings announcement. Another dividend-oriented company that we don't talk about a whole lot anymore, but in the old days we did a bit more. Hasbro was also one of the worst performing stocks in the S&P 500, down about 12% today. So we're talking about some really, really big movers, right? Lots of double-digit movers. And on the flip side, we actually had some reasonably strong gainers. So let's now talk about some of the outperforming stocks out there. Texas Instruments was up 1.5% after struggling here earlier this week after they reported their earnings. IBM reported their earnings last night, or either that or this morning, one or the other. But either way, this was the market's first reaction to it, and the dividend aristocrat was up about 5% here today. So slowly but surely, while people have fallen out of love with IBM over the last several years as it's gone basically nowhere, strangely enough, it has been outperforming a lot of the higher growth areas here, especially more recently. So it's actually out of the blue zone on the dividend stair-step charts, or it was. I don't know if it is in real time right now, but it was kind of flirting back and forth with it here over the past couple of weeks. So interesting to note, because as I've mentioned to you in the past, the vast majority of stocks I cover on the dividend stair-step charts are in the blue zone right now. 54% was the last number that I noticed at its high, which was, I believe, yesterday. That number wasn't quite as high today because we had a lot of those dividend stocks bouncing back, and some of them bounced out of the blue zone. Nonetheless, the point holds that, if you threw a dart at the 700 companies that are on the CCC spreadsheet of companies that have raised their dividends for at least 5 years in a row or more, there's a better than not chance that your dart landed on a company that is trading in the blue zone. And then you look at something like IBM, and strangely enough, it has quietly strengthened here recently to be one of the few companies not represented by that, even though it was a perennial, habitant of the blue zone for, the last, let's call it 3 or 4 years or whatever it's been. So that's been really interesting to watch as well. And, when we do our dividend growth investing classes on Tuesday mornings, I always have these head-to-head analysis matchups where we then go to have the entire class vote, and the collective intelligence gathering is how we build our portfolios. And it's been interesting because IBM has lost the vote over and over and over and over again. So even my own students, I can tell, are kind of sick of it. And it's almost like people can't stand it so much that there's nowhere left for it to go, but up, because everybody else has already sold it. So it's kind of an interesting case study there of, not a super exciting story by any means, but one that has actually held the line nicely here compared to a lot of other dividend stocks lately, that's for sure. Other stocks that were up today, Bank of America had a nice day. It was up about 2.5%, somewhere in that vicinity. The banks in general were green today, so it's good to see. We did have a conversation about the financials in my question and answer session earlier today, so I kind of ran the gamut from banks to insurance to brokerages to investment bankers to exchanges and asset managers and everything else in between, as far as what are the different business conditions that would be ideal or allow them to have kind of reversals or pivots take place. So if you are a premium member of Market Scholars, I would invite you to check out my recording. As always, it is posted on our Trading Rooms tab on our website. In addition to that, we had quite a conversation today about real estate investment trusts. A lot of my students are becoming interested in some of that merchandise that has sold off here recently, and the REITs actually had a very nice day. We'll be talking about American Tower here a little bit later, but you can see it was up 8% today. That's a huge day for a REIT. Equinix was up 5.5%. Some of you saw me tweeting about that one yesterday afternoon as I about fell out of my chair when I found out that they raised their dividend by 25%. 25% is a great number in a great economy, let alone coming out of the blue, out of nowhere, raising it 25% within a sector that has been bludgeoned here this year. Most dividend increases within the REITs here recently have been closer to like 4 and 5%. So 25% is extraordinary, and you can see that the market applauded that decision in a big way today, sending its shares higher by 5.5%. Others, REITs, you can see there in front of you, did reasonably well. CCI, little pin action there off of AMT, was up about 5%. Digital Realty was up about 3.4%. They reported earnings after hours tonight, by the way, so we'll see maybe a little bit more price activity out of that one tomorrow. And then SBAC was also up about 5%. And similar to CCI, it is a competitor to American Tower. So American Tower kind of carried the torch for that particular specialty REIT area here today. But you can see even within the other REIT areas, you had way more winning stocks than losing stocks. Same thing held true with a lot of the utilities, right? The vast majority of these utilities closed in the green today, including NextEra Energy, up another 2%. So whenever you see both REITs and utilities doing well, especially on a day when the market itself was down, it should, the first thought in your head should be that interest rates likely pulled back a little bit. And I think we will be able to confirm that here after just a little bit. So those two interest rate sensitive areas really held up nicely here today. Let's go ahead and now pop on over to the main part of the platform. And I posted this on Twitter here just a moment ago as well, but to confirm it for all the rest of you who might not be on Twitter, I found it particularly interesting that on a day when the S&P 500 got hammered down 1.18%, so a big day, right? Anything more than 1% is a pretty substantial sell-off. Yet look at the market breadth numbers here. We've got the S&P 500 components pulled up. The advancers were 242, the decliners were 261. That's nearly an even split there, right? There's 48% of the stocks in the S&P 500 closed in the green today on a day when the S&P 500 was down 1.18%. That is not normal. So as I said on Twitter, score one for the little guys, because that's the little guys pulling their weight today. And it kind of being masked, their strength, the little guys' strength is being kind of masked by the tremendous weakness in the mega caps, particularly the Magnificent Seven that I just had mentioned there a moment ago. Let's go through a few earnings announcements because we're in the heart of it still at this point, and there's some important movers after hours. So let's talk about Amazon first because that's the biggest one from a market cap perspective that's reporting after hours tonight, and it has been wild. You can see that initially when Amazon reported their earnings, their stock spiked massively, all the way up here to about $126. Now, to put that in perspective, you can see it closed under $120, so immediately shot up about $6 per share. So that was the initial reaction to the earnings report. Interestingly enough, after about an hour or so, all of those $6 worth of gains disappeared. This thing actually was trading negatively at one point in the after-hours session, down to a low of just under $118. And again, we closed at $119.57. So we went from being up $6 per share to being down over $1 per share. That's some pretty wild trading activity on a company that's worth over $1 trillion in market cap, right? We're talking about billions of dollars just evaporating and then reappearing once we caught, perhaps it's the conference call that took place and the stock shot right back up. So strangely enough, where we find ourselves right now, here a couple of hours after the close of the market, is back to the initial push that happened immediately within the first 5 minutes. But along the way, we actually lost all those gains and actually were negative for a little bit. So this is particularly wild. It usually doesn't work out that way. Usually once the market kind of gains its traction, especially on a big company like this, it's going to see the momentum push it around. Initially, the momentum looked like it was going to be the upside, but then it evaporated all those gains, and usually that kind of leads to further downside action. But this was very unique, where it was almost like the initial reaction was correct, the reflex to that initial reaction was wrong, and the market corrected it a little bit later. So anybody who bought up here and then bailed on it down here is probably living with a few regrets in the after hours session. Remember, it's kind of like Wild West in the after hours. You got to be a little bit more careful with that. But right now, that's a positive sign for the market in general that Amazon is trading at about $126 after hours. So the S&P 500 is responding somewhat nicely to that as well. As you can see, SPY, as an example, closed the session at 412.55, but in the after-hours session, it's currently trading at 414.34, so up a couple of bucks per share, mostly due to the enthusiasm around Amazon, I'm sure. Let's talk about some of the others that reported earnings after hours. LHX is another one. This is a military and defense company, and of course, a lot more, talking about those companies here recently, with, with which breaking out in Israel, Gaza, and et cetera, and looks like at the moment, market participants are setting that stock a bit higher, a couple of bucks per share after hours. So that doesn't hurt. They're not obviously as big as Amazon, so they're not going to have as much sway on the S&P 500, but at least they're not hurting it at the same token. One stock that is hurting it a little bit is Ford. Ford is a very small price stock, but still has a reasonably big market cap, not anything close to Amazon nonetheless. It's kind of a bellwether for the car industry of sorts. So it's an important one to keep your eye on. And you can see that Ford is trading a little bit lower here after hours. The end of the day at 11.35, currently trading a little bit below 11. So not a huge meltdown after hours, down about 4% according to the headline I see over here, but one to be aware of nonetheless as we head into tomorrow's trading. Another one that reported after hours, Chipotle. I'm a big fan of Chipotle, as is my son. It's kind of been interesting to watch that as well. When I was a kid, it was probably, the kids all ranted and raved about McDonald's, I'm sure. But it's interesting because if you ask my 9-year-old point blank if he would rather have McDonald's or Chipotle, it'll be Chipotle 9 out of 10 times. So it's kind of interesting to see how consumer tastes change a little bit out there as well. But I have been a loyal burrito eater from Chipotle since the year 2001, if you can believe it, well before their IPO. I grew up in the Midwest, and it was actually based out of Denver, and therefore kind of grew from the middle of the country towards the coast, kind of the opposite of what you traditionally see. Nonetheless, Chipotle has been a fun stock to watch over the years and to kind of learn from as well, right? They had, of course, their whole salmonella scare and all that kind of stuff for a while, and people to this day cannot believe that this is a burrito company that trades for $1,800 per share, but it has been a tremendous success. And you can see that the success rolls on in the after-hours session tonight. They ended the normal session at 1806. They are up about $60 per share or thereabouts in the after-hours session. Their highest level they traded after hours was 1910, but kind of settling in at around 1840 at the moment. So we'll see where things shake out as we head into tomorrow, but right now looks pretty good for Chipotle shareholders here as well. Things aren't going to look quite as well in the solar energy industry. So let's talk about Enphase Energy now. Remember, this was one of the stocks along with that other ticker symbol SEDG that got just hammered one of those days. I think it was last week or the week before. They were down 25%, somewhere in that general vicinity. It was crazy. One day, just getting hammered. Well, I got bad news. It's going to get worse before it gets better. This Enphase company is closing the normal session today at $96, and the current bid-ask spread after hours is below 80. So we're talking about a $16 haircut here at the moment, and that is going to leave a mark. That is a really ugly percentage drop right there. And as you can see, the 52-week low on this one was $90. Well, that's going to be blown straight through tomorrow, and the new low is likely to be, closer to $80 as soon as we open up trading, and who knows where we go from there. So Enphase is not the type of company that's going to have a huge sway over the market, but it does represent kind of that, alternative energy growth-oriented area that was red hot for a while. Well, it's cooled down in a tremendous way here, especially over the past month or so. Another stock reporting after hours here tonight, Intel. Intel is not nearly as powerful and important today as it was in years past. Nonetheless, still a bellwether for the semiconductor industry. And as you can see, Intel shareholders are cheering on their after hours activity. Stock closed the normal session at $32.52, currently trading closer to about $35 after hours. So a pretty steady little pop higher there for Intel. They are kind of in the middle of their 52-week range, but you'll recall that earlier this year they were quite controversial because they decided to cut their dividend and shore up that capital to kind of build out some of their fabs and other semiconductor facilities, especially here in the United States. And so far, kind of looks like that was probably the right decision, right? Other companies like VF Corp also cut their dividends earlier this year, and those stocks continued to tumble after that. But in this case, Intel might have made the right decision for the health of the overall business to cut the dividend. And now the shareholders are applauding some of their advancements in earnings that they've made as they are redeploying capital in a different direction as opposed to sending it back to the shareholders. And then the last one that I wanted to bring up was Dexcom. Dexcom has been pushed around with this whole conversation about Mounjaro and Ozempic, excuse me, and those weight loss drugs, but they are going to have their time in the sun here tomorrow, it appears. So they're down quite a bit from their highs and had been struggling, but it looks like maybe earnings were not as bad as were feared because the stock traded at $81 at the close and currently in the after hours session trading above 93. So a really nice 10% plus type of a move out of Dexcom expected to the upside tomorrow. So as we went through all of that information, you'll notice that the vast majority of those companies actually had positive responses to their earnings, which then sets the S&P 500 hopefully up for some sort of a Friday bounce. We could use it. It has been a tough go of things here recently. Speaking of which, let's advance our thoughts now on over to the charts here. And a lot of times whenever we have a 1% plus type of a move in the market, whether it's an up move or a down move, I like to start with this chart 6D so that way we can get a feel for how volatile things have been recently or not volatile. Sometimes they're not, sometimes they are. Well, I would say things are getting a bit more volatile here recently. It's not nearly as volatile as where we were a year ago, where we had some tremendous moves up and down in the fall. Remember, it was about a year ago when we finally started bottoming out in the market in 2022. And at that time, about a year ago, we had the VIX up at about 28 at that time. Notice that the VIX today is at 21. So it's tremendously lower, and it's another way to identify that the volatility today has not been as extreme as it was just 1 year ago. It might feel like it because in a trader's lifespan, a year is a long time. A lot of us forget how we were feeling exactly a year ago. But for the S&P 500's purposes, there has been more volatility last year than there is in this current swoon that we are living through. It hasn't been pleasant, so I don't want to paint that picture either, but I just want to remind folks to have the proper expectations, because if they think what we've just gone through is the worst thing they've ever seen, they ain't seen nothing yet, right? We've definitely seen it a lot worse. So prepare yourself mentally for hardships whenever possible. I think it makes surviving the markets a lot easier if you're mentally prepared for what sort of negative outcomes could exist on the horizon. But it has been a tough go of things, especially recently. If you look at the price candles of the S&P 500 up above, we've had 1, 2, 3, 4, 5, 6, 7. So 7 out of the last 8 trading days have been to the downside. Remember when I was last with you on Tuesday was actually the only day during that 8-day span where the market was up. And you'll recall what I had mentioned to you at that day, which was don't get too excited about one day. One day does not make a trend. That was the reason that I did the bearish trade example at the end of that trading video on Tuesday, despite the market being up, right? Other people might have been more optimistic and saying, here we go, this is our moment, we're going to start making a bounce. And I'm like, no, let's take advantage of this by doing a bearish trade. And you can see for the last 2 days why I think the way that I do in that regard. And a lot of times I like to go counter to the market to kind of balance out the trades if possible. But especially in that case, and the way that I described it to you at that time, is I didn't view that bounce on Tuesday as particularly important. Yes, it was a solid breadth day, but it didn't change the shape of the chart. We did not get above our moving averages. It was just a brief little pop higher and was ripe to be sold as opposed to bought. But as we have now fallen a couple more days, earlier in today's session, we actually had an oversold cluster signal once again. But once again, it disappeared by the end of the day. That's at least the third time in the last month or so that has happened. I recall that there were at least 2 other times, both happening on a Wednesday, because I talked about them in my Wednesday morning factor-based swing trading class, where we also had an oversold cluster signal in the morning, but by the end of the day, it disappeared because we closed a bit off of the lows. So this is now at least the third time, and perhaps there were other times that I just didn't notice because I had a couple days off and I was sick there for a while, so it could have actually been a couple more days in there, but I know at least 3 different times here over the past month and a half or so where we've had oversold cluster signals on the S&P 500 in the morning, but just by happenstance they disappeared by the closing bell, so they are no longer on the chart. So that's been kind of a weird feature of this market lately as well. But you can see down below these red lines in kind of this middle area of the chart are stretching down and away from this 0 black line that we see here horizontally. And in the last 1, 2, 3, 4, 5, 6, 7 trading days, 4 out of those 7 trading days have been days where the market is down more than 1%. And as most of you are aware, if you've been with me for any amount of time, on days when the market is down over 1%, I like to sell puts on indexes or stocks that I admire or what have you. And today was no exception to that. We'll talk about that a little bit later on in tonight's video. Let's take a look at our 4 grid here. And we've got the S&P 500 index that was down 1.18% here today. We have the Dow Jones Industrial Average down just 0.76% today, so pretty noticeable difference between those 2 large cap oriented areas. Remember, the S&P 500 is going to have a lot more tech exposure. It's not that the Dow Jones doesn't have any tech exposure, they do, but it's just not as concentrated. So that was allowing them to kind of hold up a little bit better. The NASDAQ is where you have the highest amount of concentration of tech stocks and growth stocks in general amongst these 4, and therefore, no surprise, it was the one that did by far and away the worst. NASDAQ was down 1.76% today. That's a really ugly day for it. And then guess what? Russell 2000 was up today. How about that? And that kind of jives with what we were looking at there on the heat map a moment ago. Remember me talking about how the financials were up today, especially the banks. And not just that, but the REITs and the utilities were up today as well. And so you're going to have some of those less important sectors that have a higher concentration level in the small cap index than something like technology, which dominates in the large cap indices. So it was interesting because the Russell 2000 closed up on a day when a lot of people felt like it was a chaotic sell-off type of a day. Another interesting feature of the Russell 2000, and this doesn't happen a whole lot, it's possible, and I see a couple examples on the chart right now, so it's not particularly rare, but it is still strange and different and not what you would expect. On a day when the Russell 2000 was up, you still had an oversold cluster signal. So that goes to show you how bad the selling was prior to today, that even on a day like today where it was up, you still ended with an oversold cluster signal. Now, to be fair, that also happened right here, right before we went on a big run for the next 4 days. It also happened over here where we didn't really go on a run, but we didn't continue the selling until about a week later. So maybe that's a little sign that there wants to be a little bit of run and gun back to the upside for the Russell 2000. Now, again, that doesn't mean that I'm expecting a trend change here. It just means that things have gotten really oversold, and maybe this is a sign that we're due for some sort of a short-term rally like in the next week or so with the Russell 2000. So we'll keep our eyes on that. Be aware that we did have an oversold cluster signal on the NASDAQ composite today as well, as I can see that little green dot emerging down there. And I want to correct something I stated a little earlier in the video when I said the S&P 500 did not have an oversold cluster today. I now see that it did. So I guess the reason I was thinking that a moment ago is because that other chart is not set up with cluster signals. Most of our charts are, so I'm not as familiar with chart 6B or whatever it was. I don't look at that every single day, so I just wasn't thinking that. But let me check one other thing, because sometimes SPY is a little different, but no, in this case we got it there as well. So let's make it official here. And again, correcting what I stated before, now that I've witnessed with my own eyes the truth. But let me right click and maximize the chart and show you that we do officially have an oversold cluster signal here today. Notice the little green dot underneath today's price candle for SPX. We also have the little green dot corresponding with the indicator down below, identifying with our eyes that the blue, the green, and the red lines are all in the lower reversal zone on the same day. And that has been very rare. As I mentioned earlier, there were 2 other days here recently, both Wednesdays, where in the morning we had the cluster signal show up, but we had a bounce by the end of the day, so it disappeared. This one is official now, so this one will stay on the chart, even though the other 2 did not. This one will. So to show you how, excuse me, still dealing with this dry cough. It's so annoying. I apologize from being sick last week, and it's like I'm pretty much feeling better and back to normal, with the exception of that weird dry cough that I'm dealing with. So if you ever hear me coughing, it's not because I'm trying to be rude or disruptive. It's just coming out of nowhere as I'm speaking. So it is what it is. But anyway, let's take a look here at a further back chart to put this into perspective. And if we look at a year-to-date chart, meaning from January 1st, you will notice that today is our very first oversold cluster signal of the entire year. If you can believe that, right? Now this is, of course, the market cap weighted S&P 500. Like I mentioned to my class earlier today, there is a tremendous difference right now between the market cap weighted S&P 500 and an equal weighted version of it. Let me show you something with RSP now. RSP is an ETF that tracks the equal weighted S&P 500. So as opposed to putting more weight on Apple and Microsoft and Nvidia and Tesla and all those, instead what it does is it chops up the S&P 500 and distributes it evenly across all 500. So basically every one of those components has basically like a 2% weighting in the outcome. And one interesting element of the market right now is that the S&P 500, the traditional one that you hear people talk about on CNBC and what have you, notice that it is up on a year-to-date basis. So we started the year over here at about 3,800, and it's currently trading at 4,100. Obviously well off the highs, but still up easily from a year-to-date basis. So if the markets were to magically close right now for the rest of the year, this will be viewed as a positive year for the stock market. And a lot of us are kind of like doing double takes when we hear something like that, like this was a positive year. Like it feels like a gut punch out there for certain areas of the market, including my beloved dividend stocks. So I certainly don't feel like this has been a good year, but it is true. The S&P 500 is up this year if you're looking at it through a market cap weighted approach. But if instead you're thinking of it from the perspective of throwing a dart at the 500 companies in the S&P 500, and each one of them has an equal chance for that dart to land on it, then it's a completely different story. You will see that RSP began the year at around $141 back here on January 1st, and today it's at $135. In other words, it is down year to date. So it's telling you that the average stock in the S&P 500 is down this year, even though the S&P 500 itself appears to be up. And that is courtesy of the Magnificent Seven effect that I had mentioned before. In fact, another way to kind of think about this is going back over here to this heat map, and instead of looking at it on a one-day basis, let's look at it now on a year-to-date basis. And look at how the picture changes so dramatically. And look at those Magnificent Seven companies. Microsoft up 36%, Apple up 28%, Nvidia up 175%, Google up 39%, Meta up 140%. Amazon up 42%, and Tesla up 67%. And since those are the biggest squares, they're the ones that are going to have the biggest impact on the actual S&P 500 from a market cap weighted perspective. But if you just somehow magically ignored those big green boxes right there and looked at the rest of the market, look at all those red squares and rectangles. I mean, the vast majority of them are red. So that explains the difference when we're looking at this chart as well. RSP is down on a year-to-date basis. It has been a bad year for the stock market, exactly at the same time that the S&P 500 has been up. Go figure. But that's why they play the game, right? It's you can have your assumptions about how things should work, but until things actually play out, you don't know for sure. So this is a very, very strange year. Well, anyway, notice that RSP was barely down today. It was only down 0.21%. That's an afterthought. Again, putting that into perspective, S&P 500 was down 1.18%, so it was a huge sell-off day for SPX. RSP was basically break even. In fact, there were certain areas within the market, some of you saw me tweeting about this within the first half an hour of trading today, even though I didn't know how we would end, so you always have the chance of ending up with a little bit of egg yolk on your face when you are, posting your thoughts on Twitter and elsewhere. Some of you would have noticed within the first half an hour of trading today, I had mentioned that the dividend stocks were up on a day when the market was getting hammered. So even something like DVY was up 0.38% today. Something like SDY, so Sam David Yellow, not SPY, but SDY, which is the S&P 500 dividend ETF, was up 0.33% today. NOBL, which is the dividend aristocrat list, it looks like it was basically break even today, but obviously a massive outperformer versus the market at large. And, I think SCHD was a little different. I had actually mentioned this one here a moment ago as well, that on a weekly basis, so let's change this just for a moment here to 1 year weekly candle chart, SCHD, which is an ETF that a lot of dividend investors have fallen in love with here in the last year or two, actually has an oversold cluster signal right now for the first time in over a year. Right, so some of those dividend stocks have really sold off, but today obviously outperformed the market. So the point is, SPX really, really struggled today because of the Magnificent Seven. But it is the exact opposite of what has occurred for most of this year when the Magnificent Seven has basically propped up the rest of the market. So to make it official, this is the very first oversold cluster signal on SPX in the past year, not just on a year-to-date basis, which starts about right here, but even if we went back a full year, notice there are no more green dots on this chart. The only one is the one that you see under today's candle. So, for those of you that are newer, you might be wondering, well, what does that mean? Is that good or bad or otherwise? Kind of depends upon your perspective on things. For me, it means that the selling has gotten a little bit too extreme, and that there may be an opportunity for a short-term reversion to the mean type of a bounce. Whether that happens or not is, of course, out of my control. But that is how I'm preparing my mind when I see things like that, especially in this case where they're quite rare. Right? Sometimes you can have indices that have cluster after cluster after cluster, and it's kind of like the boy who cried wolf. When you hear the boy who cried wolf for the 20th time in the last month, you assume there is no wolf. But when you have a situation like the S&P 500, where for 250 trading days has not had an oversold cluster signal and all of a sudden does today, you kind of sit up and pay attention to that a little bit more, right? So I think that's kind of in the market's bullish camp in the short term, that finally it's kind of like the fever breaking in a way. And yes, it can always get worse, so we have to be conscious of that. But at least in the ultra short term, there could be an opportunity for a reversion to the mean there. You can see that of all four of these charts here, 3 out of the 4 ended with an oversold cluster today. The only one that did not was the Dow Jones, and that one just narrowly avoided it. The blue line was at 22. Remember, it'd have to be below 20, and if it was, it would have been a clean sweep of clusters today. But the Dow held out, and so we'll see if maybe that's in the cards for it tomorrow. But all 4 of these charts remain with strongly bearish postures. according to the market forecast, on an intermediate basis, even if they have the potential for a short-term bounce because of the extreme oversold conditions in the short term. And then all four of these charts, as you can easily see, still have their red 30-day moving averages, meaning prices below their falling 30-day moving averages, which means the path of least resistance does also continue to be to the downside. Let me come on over here now to the internet. I want to say thank you to those of you that help support these presentations. As I always say, I'll give you a full-length, hour-long presentation if you're willing to take 5 seconds out of your day and click like for me. As long as we're up and over 100 likes, I'm happy to do that for you and give you more than double the typical video that you would receive otherwise. And so thank you to the 101 people that took their time out of their day since Tuesday to do that for me. Let's do some shout-outs here. Thank you to Susan and to Tim, and to Common Sense Investing, and to Claire, and to Rich, and to NZ, and to Hot Rod Rob, and to Trunk, and Sherry, and Venky, and Terrence, and Vince, and Market Scholars, we know them, and Marty, and others. I can't get to all of you, but I always like to send out a shout out every so often to let you know I see your notifications coming through. I know you're going to work for us, and I appreciate each and every one of you who are committed to doing that. I hope you do that for David as well. Let's also talk about our factor selector tool now. This came out a couple of days ago, so it's a little stale at this point, and there's the potential for some movement here based upon what we've seen since then. So I'm going to be curious next Tuesday evening when this gets produced again, what, if any, changes we will see. Up at the top, we have quality. Now, quality tends to move in the direction of the biggest technology companies, so Microsoft and Apple in particular. And with those two slipping pretty violently here today and this week, it has the potential of having quality fall off that top rung. So that's one possibility that I'm going to be kind of thinking about in the back of my mind. What I've also recognized has happened here recently, and some of you might have seen me tweeting about this yesterday, but I've noticed here, when was it? There it goes, right there. I wanted to point out that yesterday, so 20 hours ago, I posted this. So I don't want to make a big deal out of this because one day does not make a trend, but yesterday I found it very interesting that consumer staples were up yesterday. And as I was going through a bunch of charts last night, as I oftentimes do in the evenings, I was going through hundreds of charts, and on the times when I would stop on the consumer staples, many of them were actually trading above their 30-day moving averages. And a couple of weeks ago, when I went through the exact same routine, that was not the case. Now, I don't want to make too big of a deal out of it because their 30-day moving averages are near the lows of the year. So it's not like a situation where we're popping back above rising moving averages. This is still a precarious position that they find themselves in. But the fact that there's an improvement at all, I found to be rather intriguing. And as you can see here, this relative strength line, looking at XLP, which is the market cap weighted consumer staples sector ETF, was basically in the bottom percentile on a relative strength reading as recently as October 10th. And since then, in the 16 days since then, we've gone from basically the lowest percentile, basically dead last zero, you can think of it as, or 1% less, all the way up to the 28th percentile. Now, the 28th percentile is still a long ways away from those upper echelons of 90 and 100%, but there is a recovery afoot with some of those areas. And as we saw some of those research reports come out earlier in the last couple of weeks with the earnings announcements, a lot of those consumer staples CEOs are being asked about the weight loss drugs. And right now, they're saying the market's making too much of that. And so that's kind of given a little bit of a green light for some of those particularly oversold consumer staples companies to start making a move. Whether it continues or not, anybody's guess. But the fact that it's happening is at least noteworthy, because you can see in the past, in the last 3 months of this is actually a 6-month chart here, this has been a house of pain. I mean, constant underperformance from the consumer staples. And every time you had even a little bit of a pop higher, it was immediately resolved to the downside. This is the most aggressive pop higher, and it has not yet been resolved to the downside. In fact, this was yesterday, it would probably be even more impressive if I were to look at it today, given what just happened to the S&P 500. Because basically what's happening here is you're comparing XLP to the S&P 500. So I would venture to guess that it's even higher. I could probably check that here in real time. If I pull up chart 1A and look at XLP, you can see down below where we generate that relative strength line. It's going to take a second to pull up here because it's going through a lot of data. So this one's a little slower than some of the others. So hang on just a second. It's waiting for the data, but it'll pop up here if you give it enough time. There it goes. So you can see that yesterday when I took the screenshot, it was at 28. Now it's at 31. So we've shown an additional improvement there. And again, I don't want to make a big deal and throw a parade for an instrument that is in the 31st percentile of relative strength. That's still not a good number, but the fact that it is so dramatically off of the worst numbers in such a short amount of time is noteworthy to me. And so we'll see if that can continue or not. And if it can, then it's going to likely have an impact on things like low volatility and dividend yield. They would have an opportunity to make their move higher. Dividend yield already did week over week, but what it's also competing with is the fact that low size probably did pretty good today as well, right? Russell 2000 was up when the other three indices were down. And so it's going to be interesting to see if the jolt that I've been witnessing in the market here in the last week or so is going to have an opportunity to have a pretty big upheaval within the rankings of the factor selector. I think the conditions are ripe for that. Whether it actually happens or not is anybody's guess, but it does feel a little bit different here all of a sudden compared to what I had been feeling about the rankings here in recent weeks and months. So let's keep our eye on that. And of course, assuming you guys continue to click like for me on these videos, we'll have the opportunity to continue to discuss things like the sector selector and the factor selector in my videos that I do for you next week. So we shall find out together. At a minimum, if you're a premium member, remember we'll have this conversation Wednesday morning no matter what in the factor-based swing trading class. All right, let's get back on over to do a little bit of 12 grid analysis now. And in today's case, I wanted to look at, excuse me, the ratio charts. This is 5Q on our 12 grid. And you can see here that one of the things I wanted to kind of identify was the equal weight versus the market cap weight, because this is a big jolt. So let me right click. And actually, I can't do it on these ratio charts. My apologies. But you can see pretty good, even if you're on a phone, that this candle right here in the orange down below was a pretty violent one, right? You don't see a lot of those candles to the upside in the 3 months of this chart. If you saw a big candle, it was something like this or like this to the downside, right? This has the potential of a diagonal downtrend breakout that's taking place here. And it's another way of saying things went too far with the Magnificent Seven. They didn't deserve to have the immense amount of additional market cap tacked on at the risk of losing the market cap to all of the other companies in the S&P 500. So keep your eye on that story. A lot of what the theme of this video so far tonight has been this upheaval and this change that seemingly has happened in a very, very short amount of time. We've seen stuff like this fail in the past, but usually you weren't at a point of kind of that breakout area, right? And in this case, you might be able to get away with saying that. Like if you were to get a drawing tool out here and you were kind of looking at this area, you can see, depending upon how you draw the line, and of course, technical analysis is in the eye of the beholder, but if you drew a line somewhat like that where we ended today was above that area, so that you could get away with calling that a diagonal breakout, meaning that the average stock in the S&P 500 now has a chance to outperform those Magnificent Seven companies until that reverts back to the way it was, right? If it does. Maybe this will go on a multi-month run. We don't know. But the point is, it's different here all of a sudden today. Also of note that is interesting is look at the big drop in growth stocks versus value stocks over here with this green ratio chart. In this case, when the chart goes down, like it did significantly today, that means that growth stocks woefully underperformed value stocks. And that is different than what we've seen for most of the last 3 months as well, right? This is an upward trending chart that appears to start to be breaking down right now. In other words, growth stocks were easily beating value stocks up until here recently, and now there was a fairly big rug pull in that regard. You'll also see that discretionary sector is woefully underperforming the consumer staples all of a sudden. And remember, that had not been the case either. You had a situation previously where Tesla and Amazon and Home Depot and those types of companies in the consumer discretionary space were easily beating all of those super boring food and beverage companies that were getting their head handed to them by the weight loss drug narrative. Well, look at what has happened here in just the last 2 weeks. That thing has flipped on its head. Remember, it was just a couple of weeks ago I was telling you guys about how Pepsi and Coke had entered into the blue zone of the dividend stair-step chart for the first time since 2020. And in that time since, that almost marked the bottom for the consumer staples in this regard, where at that moment, it was an opportunity to maybe rotate out of some of your favorite discretionary names into the Coca-Colas and Pepsis. And if you had done that, this was a very nice bout of outperformance that you just received. This looks like it's falling off of a cliff here in just 2 weeks, right? So it's basically saying staples are now dramatically outperforming the discretionary stocks. And before, that was not the case, right? Similar to this chart of growth stocks versus value stocks, the general trend of this pink chart was to the upside. The last 2 weeks have been a major reversal there. So while we don't normally spend our 12 grid time on these ratio charts, we oftentimes look at some of the other charts that are out there. I wanted to spend a little bit more time on that here tonight because we are noticing some differences all of a sudden. Things are changing. Whether those changes hold remains to be seen, but things are definitely changing here all of a sudden. All right, let's get into our trade application example now. And as I had mentioned to you earlier, on days when the S&P 500 is down more than 1% and it happens to be a Tuesday or a Thursday, you should assume, unless you hear otherwise, that I will be presenting a sold put trading opportunity to you in the trade application example. And we've had a few more of those opportunities here more recently, whereas earlier this year, remember when I was kind of bemoaning the fact that we were going forever without doing that because we didn't have very many 1% sell-off days. More recently, we've been starting to get them, so I've been a little bit more active in that front. But by the way, here's the default chart that pops up when I bring up the dividend stair-step chart, but it matches what I was just mentioning a moment ago, so now I will show you and confirm it visually that Pepsi right here 2 weeks ago touched that blue line on the dividend stair-step chart. It actually gave you an oversold cluster signal on that day as well. I know it's hard to see because it's kind of blending into the blue line itself. But so far, Pepsi has been bouncing from that level. You only had 1 day. It was a Friday. I know that because I teach my dividend class on Tuesdays, and I really would have wanted to present Pepsi to my class on Tuesday, but unfortunately, I cannot control the market, so it is what it is. But it's kind of interesting to see it bouncing perfectly out of that zone right there, and their chief competitor, Coca-Cola, was much the same. Came down, touched that blue line, and then popped straight back out of it. So those two have acted particularly well to that dividend stair-step chart that we provide for our premium members here. And remember, if you're not a premium member and you want access to these charts along with the 10 weekly classes that David and I give our premium members, we will likely be having our Black Friday sale next month. So stay tuned for that. Might as well save a few bucks if you're going to be with us here for the next few years. Anyway, let's get into the actual trade application example now, which is, I will tell you before I get started here, this is not my normal MO for these trades. So this could be a little bit more experimental, and we'll see. Maybe it'll end up burning me. Nonetheless, it is what I did, and it's just paper money. So let's go ahead and talk it through and see what we can learn. So I sold a put on American Tower today. Now, for those of you that don't know where I'm going with this conversation as to why this is different than the normal sold puts that I feature in these videos, is because American Tower was one of the best performing stocks in the entire S&P 500 today. It was up 8%, a huge day for this particular REIT. So normally you'll see that my approach is that on a day when the S&P 500 is down more than 1%, as it was today, I will be selling puts on a dividend growth stock that is also down considerably on that day, and oftentimes having its own like oversold cluster signals and different things like that. So normally we're talking about stocks that are sold off pretty aggressively. Today I'm doing that on AMT on a day when it was one of the best performing stocks in the entire market. So it's a little different. Now, in my own head, I don't necessarily think it's a terrible idea. It's just a different idea. You can see here that American Tower, unlike Pepsi and Coke, has come into the blue zone of the dividend stair-step charts, and it's basically lived there for much of the last year. So even though it was up 8% today, it has been down tremendously over the last year, and therefore 8% is a bit of a drop in the bucket compared to the grand scheme of the losses that shareholders in this company have seen. And so, again, I'm not sure it was the best idea. We'll probably find out together. But what I ultimately did was I sold the December 155 puts, and I received $1.60 for doing so. Remember, I typically target the 1% return on risk. And so if you want to see this on kind of a more close-up view here, if we were to pull up like the swing trading chart to look at the daily candles instead of the weeklies like we were just a moment ago, here's what AMT looks like after today. In other words, a huge bounce to the point of it going from basically underperforming the S&P 500 for the entirety of the last 3 months to in one fell swoop with an 8% move higher today. Now that candle's actually trading above that gold dotted line there representing the pathway of the S&P 500. So it's actually a market beating security as a result of one single day. But it was an important day. As you can see here with the trading activity, it had already attempted to bottom over here on October 6th. It put in its low at 154.58. Notice on its subsequent move lower, where traditionally in the past it had breached the prior low and formed yet another lower low, right? That's the whole point of having trends or looking for those trends, lower highs and lower lows. This time it refused to do it. It looked like it was going to, right? You had this perfect setup where it went up to the downward trending 30-day moving average, just like it did back here and back here and back here. But unlike all these other times when it touched it, it went down for the next week, but it did not breach that prior low. So it's a sign that this stock, or in this case technically a REIT, is being more stubborn than it was willing to be earlier in the year. And now you're kind of carving out this bottoming process right here. Almost gives you the impression of an inverted head and shoulders pattern. And with today's big move, you've now busted above this prior resistance area here at around 169, and at the same time slice straight through that downward trending 30-day moving average like a hot knife through butter, right? There was no resistance there whatsoever. And that is a powerful sign, basically saying that the traditional technical analysis is now being thrown out the window, and market participants are willing to buy this stock as it was roaring higher at ever higher prices today. They didn't care if they were getting a discount. They wanted to push themselves into this particular trade. And you'll notice here that 154.58 was the ultimate low, and that was the 52-week low on this stock as well. And as I mentioned before, I sold the 155 strike, and I got $1.60 for doing it. So if you get your calculator out here, take $155. Remember, for those of you that are newer to the idea of selling puts, I teach an entire class on it every Monday afternoon, but the idea behind it is to generate an income stream by selling put contracts at strike prices on companies that you want to own for the long term. at prices that you deem acceptable. So if you deem $155 per share an acceptable price to pay for an American Tower, then selling a put allows you to generate an income stream. Today I took in $160 for my willingness to buy it down at $155 per share. Of course, you got to do 100 shares. That plays a role there as well. But the point is, $155 is my strike price. If I subtract what I got in credit, which is $1.60, that means that my break even on this trade is at $153.40. And at that rate, you're going to have an awfully high dividend yield, right? You also have to breach the prior low. So if you think this actually was the low and that this higher low was telling you something, that there was a trend change afoot, then you're basically saying the only way I'm going to be put this stock and get into hot water with it is if it breaches that low and your interpretation of that chart was incorrect, right? But if that is the case, then of course you do have the advantage of having an awfully high yielding company at that point, because this company pays $1.62 per quarter in dividends. So if I take $1.62 and annualize that quarterly payment by taking it times 4, that's $6.48 in terms of the dividends per year at the current rate. If we divide that by what our cost basis was that we just figured out a second ago, 153.4, again, that's a theoretical cost basis because we don't know if we're going to be put the stock, but if we do, that will be our cost basis. Then our dividend yield will be a fairly attractive 4.22%. Now, to put that into perspective, because some of you might be thinking, well, isn't this a REIT? Isn't that a pretty normal yield for a REIT? It is, so you're right on both counts. But remember, not all REITs are created equal. If we were to come over here and take a look at chart, let's see, where is it? 2C. Don't bring this up a lot. I used this earlier today on Twitter when I was showing you C.H. Robinson's chart, and I bring it up occasionally, but it doesn't get brought up as much as the dividend stair-step charts, but it's useful in this conversation because you might be wondering, is 4.2% dividend yield high for American Tower? Well, the answer is yes, extraordinarily high. Here is the dividend yield charted throughout history over the last decade. And you can see that this purple line is mostly down here closer to 2%. So if you were forced to take ownership of this stock with your starting yield being 4.22%, which is way up here, I'm circling it way up here, that would literally be 2 times what the typical yield has been for much of the last decade for this specific REIT. This had been a very weird REIT. It was very successful. It actually became the world's largest publicly traded REIT until the most recent sell-off that it's had. It no longer is, but at a time it was one of the biggest, if not the biggest, out there. More than $100 billion market cap. And so when prices keep on going higher, the dividend yield, can't really gain any traction to the upside. Now that prices are going lower, that dividend yield is gaining major traction to the upside. So anyway, I found that to be fascinating with this one as well. But it's not for everyone, right? You have to be committed to the idea of owning this for the long term if you are going to take a trade like this, and certainly not all of you will be, because not all of you are long-term investors. But for those of you that are, kind of an interesting setup there on a reversal candidate on a day when the market was down over 1%, this stock up 8%, and if you're forced to take ownership of it, you basically end up having double the yield that most people were willing to accept on this stock for about 7 out of the last 10 years. Okay, that's what I had for you here tonight. Hope you enjoyed the video. If you did, I have one simple request for you. Click like for me there on Twitter. You can do that a number of ways. You can either go to my Twitter feed and it'll be pinned to the top of my timeline. You can also, if you're watching this video right now on the Market Scholars website, use the little Twitter widget directly below the video to click like. If you are watching this directly on YouTube, I will have the tweet in question listed in the description area of the video to make it easier for you. And then if you are receiving our emails on our email distribution list, at the bottom of the emails, you'll see an icon with a black X in it, representing the new name of Twitter, X. And if you click on that icon, it'll take you to the correct tweet as well. So Any one of those four ways will get you done, but I certainly appreciate it either way. And I'm sure that David will be back with you tomorrow as well, so we'll look forward to hearing what he has to say about the market. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.